Well, we're coming up to the first Friday of the month. Q4 is upon us already, and ordinarily that would mean we get our latest read on the state of the US labour market with the September jobs report due. However, there could be a bit of a twist in the tail this time around. If the US government does indeed shut down on Wednesday, then we are not going to be getting that jobs report because the BLS will not have federal funding. However, assuming the data is released as normal, headline payrolls are seen having risen by about 50,000 in September, which would be roughly in line with the break-even rate and also marginally above what we've seen over the last few months as the labour market has been adjusting to the tariffs and trade policies that were implemented after Liberation Day. Unemployment, meanwhile, that's seen holding steady at 4.3%, and average hourly earnings seen having risen by 0.3% on the month and by 3.7% on the year. Of course, participants will be looking out for any further signs of softness, particularly a further rise in unemployment, which could trigger a more dovish reaction from the Fed, although it does seem at the moment that two cuts at each of the final meetings this year in October and December is very much the base case. And even if we don't get that labour market report, the Fed are going to have enough private sector data, whether it be the ISM surveys due this week, the ADP data, the Challenger Gray layoffs numbers. They're going to have enough data to build something of a comprehensive picture of the labour market. So for the time being, the Fed's run it hot strategy leads us to believe that they are likely to continue delivering rate cuts. Although the September move was framed as a risk management cut, that does not mean it is a one and done cut. It is likely to be a series of rate reductions, and in turn that tilts risks to the outlook to the upside for the US economy, to the upside for the dollar, and this run it hot approach is certainly likely to lead to a pretty potent mix for risk assets going forwards as well.